Welcome to the Trending Report, brought to you by USA Financial. The Trending Report is a series that aims to focus on the trend lines rather than just the headlines. Each episode features commentary around the state of the market, as well as other factors that may impact your personal finances. The host of the Trending Report is an investment advisor representative of and securities are offered through USA Financial Securities, member FINRA SIPC, a registered investment advisor. The Trending Report is educational and not intended as personal financial advice.
Hi, this is Kevin Roskam with USA Financial, and this is your November monthly trending report. Welcome to the trending report for November. It has been quite a year in the stock market, quite a year in the country, quite a year economically and politically. The news headlines have been all over the place, and it has been a year where trends have been incredibly important. Short-term emotions kill long-term plans. It's so important to remember. I actually had a call this week from a client saying, Kevin, things are going crazy right now. I want to move all of my money to money market. And as an advisor, of course, it's something we're able to do for clients, but I think it's really important for us to understand the why, to talk through the decisions and to figure out what's going on that someone would want to make such a drastic move to go to cash now. And so the one question I asked was, why now? Why not last month or the month before? Why not earlier this year? And it turns out that it was short-term emotions. The client called me right after watching a certain channel on television, letting them know that the sky was falling. And so after talking with the client and making sure that our long-term goals hadn't changed, and that we could keep our short-term emotions in check, what we did was we reviewed the plan, and we made sure that the plan was still appropriate, and we made sure that we were prepared for what the market may or may not do in the next couple of months. And really, the main thing that I focused on talking with the client about was the fact that if we see a correction, stock market corrections are normal. What you're looking at is the average number of corrections per year in the stock market from 1928 to the present. And so what you see, first of all, a 3% dip or more in the S&P 500 happens quite a bit. A little over 7 times a year, we should expect to see a dip of 3% or more. You see a mild correction of 5% or more, on average, about 3.5 times a year. Now, even a 10% correction, which really in the market and in the industry is known as a moderate correction, on average happens about once a year. Now, when we get to a severe correction or a bear market, those happen less often. But it's always important not only to set expectations, but remind people of what we're doing. We are invested in a stock market where volatility is important. But it's also, or at least it also can be, scary. And so when you think about the stock market over time, there's a reason why we allocate the way we do. There's a reason that maybe we use fixed income or insurance products. And there's a reason we expose our money to the stock market, maybe using active management versus buy and hold strategies. And this is why. Because we know the market goes up and down. We know performance doesn't happen in a straight line, but it's always important to remember that these corrections not only are possible, but they're probable. And so the first thing to understand is, yeah, we could see a dip in the market between now and the end of the year, maybe today, maybe tomorrow. But on average, when we're following the trends, those dips are something we have to go through to get to our stated goals. And so the next chart I want to show you, I think, is pretty interesting. This looks really technical, but really what this is how are stocks correlated to the S&P 500 index. The S&P 500 index is the average return of all 500 stocks. And what this chart measures on a 63-day basis is the correlation that all 500 stocks have to the index itself. And so what you see in the middle is the 26-year mean. This is when the stocks correlate perfectly to the index as a whole. Now, that normal historical correlation range, you can kind of go back and forth between active and passive management. The idea, of course, with active management is when the market's going up, can we be exposed to the areas that are going up faster than others? And when the market's going down, can we protect? Can we shield some of our assets, move them away from the market or from the more volatile parts of the market? I thought this was important because where we are in terms of the S&P 500 index and the S&P 500 index's return versus the actual 500 stocks in the index, you can see that we're at a historically low correlation. So if you think about the Mag 7, the NVIDIA, the Amazon, the Googles, and how the Apples, and how those stocks over the last several years have really been moving the market versus the other 493 stocks available, that gives you an idea of why currently active matters. Now, there are times when on the other side of the spectrum, active management probably can hurt you. When you're so correlated that passive or just working in the index by itself is all you need to do, well, then maybe active management doesn't make sense. If you hear the commercials on television or you listen to some of the folks like the Warren Buffetts of the world who say, just buy an index fund and never think about it again, that's great for a 20-year-old. For a 20-year-old who has 40 to 45 years of working and not worrying about what the market does for their retirement, being a passive investor, when you have time on your hands, that makes sense. That can work. But when you're in your 50s and your 60s, even into retirement, that idea of this low-cost fund that no one ever looks at and is never managed and is just going to bounce around with the market, it doesn't make the same amount of sense. And so what this chart shows you, I think a couple things. Going back to that client that was worried and wanted to go 100% to cash, this chart shows you, yeah, maybe some of that fear is warranted, but what is certainly justified right now is active management. And so the question is, how are you communicating with your client, or as a client with your advisor, how are you communicating so that you understand how your portfolio is positioned for the current market conditions? Because I can talk about trends all day, every day. But if it isn't clear how my portfolio is interacting with the trends and with the short-term market movements inside of those trends, talking about it does no good. And so really what this chart is meant to do is encourage you. We are in a time period based on the median 63-day correlation where active management makes sense. And it shouldn't be something we apologize for. It should be something we should be excited about and be explaining to our clients. And so as we talk about active versus passive, that brings us back to trending. As a reminder, you may have active money managers that are trending the market or evaluating the market on a daily basis. Some of them may do it weekly, others on a monthly basis. Some might be buy and hold. A portion of your portfolio may be always exposed to the market. All of those things, if they work together, give us a really strong chance of long-term success if we understand why we're invested the way we are. And so, as we look at the 1-month trend in the S&P 500, what we saw at the end of October is we saw a dip in the market. We saw that in early October as well. But when you look at from the beginning of October to the beginning of November, we still see a reason to be invested in the stock market. The 1-month trend continues to be positive even as we see volatility. This is our 1-year trailing return. Again, we see volatility. We know that if we have active managers in place and we have managers that are doing different things at different times, we're giving our clients the opportunity to smooth some of this volatility out, but also participate as the market continues to bounce in a positive direction. And finally, as a reminder, there have been times over the last 5 years where you may have heard from clients asking you to get them to cash, asking you to move them to money market, to shield them from the volatility. But it's so important that we understand what this account is for and what it's meant to do over time. I think one of the other questions we have to remind our clients of, we even have to remind ourselves as advisors of it, is if the client and I are going to make a decision to get out of the market, the other side of that has to be true too. How do we decide when to get back in the market? Because getting out is an emotional decision 90% of the time. And that's fine, but we have to balance that emotional decision because we can't stay out of the market forever. So if we're going to get out of the market this week, when are we going to consider getting back in the market? What is the catalyst for us to reinvest these assets? What you see on the chart in front of you is really the reason why we use third-party money managers and we take our emotions out of long-term investing. Because when you look at this 5-year chart, there are several places where it may have felt good to get out of the stock market. And if you could time it and get back in at the exact time, that would have felt good too. But that's really hard to do. And so as we talk about the trending report for November of 2025, we need to look at not just what happens by the end of this year, but again, what is the long-term plan? Because the market will continue to be volatile. How are the strategies that I've invested for my clients reacting to these volatile markets? Hopefully, they're not all doing the same thing at the same time. Hopefully, they all have different evaluation periods so they can all interact independently. And that's what's so powerful about an account on the exchange platform, because you have the ability to offer that type of diversification to your clients, all inside of one account. This is Kevin Roskam with your monthly trending report for November of 2025. Thanks for listening, and we'll see you next month.
Thanks again for listening to this episode of The Trending Report, powered by USA Financial. We invite you to visit usafinancial.com to find out more about our work with independent advisors and their clients all around the country. Any projections, targets, or estimates in this report are forward-looking statements and are based on the firm's research, analysis, and assumptions. Due to the rapidly changing market conditions and the complexity of investment decisions, supplemental information and other sources may be required to make informed investment decisions. All expressions of opinions are subject to change without notice. Clients should seek financial advice regarding the appropriateness of investing in any security or investment strategy discussed.